All right. So first off, I'm going to ask everyone to mute themselves, please. Everyone mute themselves. Because we have quite a few people, and as per usual, I forgot to set the mute setting because that's kind of my thing. That's the way you know I'm running one of these meetings. All right, guys, I am thrilled today to tell you that we're about to speak with Jordon. So a couple of administrative things before we begin. First, like all of our sessions, our forum is private, although again, I'm not sure how private it is. We have over 10,000 members. But our talks are public. This is published on any number of public forums. I'm sure it will be on Jordon's YouTube. It will be on a range of others. So please be aware of that in your questioning. Secondly, anyone who wants to make comments as to my fluffy white hat, I am open to it. You can DM me, you can email me. I take any comments you want, but know that it is an exceptional white hat. Third, it is the case that I want to thank everyone for being an active part of the forum and to know that this is the last in our series of market changes. And this is going to lead me to the introduction. I don't think that there's really anyone better to actually lead us through a data-driven analysis than Jordon. For those of you who don't know Jordon runs Pre-Condo, and Jordon's analysis of where things are is not really motivated by sentiment. It is motivated by hard data. Hard data is a critical component, really, of being able to guide your way through market change. And I think you're going to see in the first 5 minutes of listening to Jordon exactly what that means and how cogent predictive analysis can be once data is actually employed. Jordon obviously functions in the new build space primarily, but of course the analysis of where we're going as a country, as a province, as a city, directly ties into both new build and resale. I have a dog that likes to bark. I'm sorry about that. I can't mute myself, but I am going to mute myself now because I'm going to turn it over to Jordon and tell you that we're in for a treat today. Jordon, maybe we can start. I was planning on having the session as a bit of a back and forth between us, but I think that would be part of the latter session. I think I'm going to just open with the general question, which is, what the hell, Jordon? Where are we now? What's going on? What are you seeing? Can you give us like a 10-minute, analysis of what you're seeing in the data? And maybe that will spike some questions. And I'm going to ask, unlike other times, people who have questions throughout, please feel free. And if you type them in, I will make sure I call Jordon's attention to them as we go. So Jordon, what the hell? Help us out.
Yeah, I'm going to share my screen. And we'll get right into this here. So first thing I want to just briefly mention, when you're providing forward guidance to clients, right? It's obviously something we sell a few hundred pre-construction units every single year. And the most common question is, what's my condo going to be worth at the time of completion? And obviously, if I had a crystal ball to that degree, I would be a billionaire sipping mojitos on the beach. I probably wouldn't be slinging units. So always be careful when providing forward guidance, because as we've seen, the market can turn on a dime. And yeah, this is the all of the big banks and institutions' price predictions for housing in Canada at the outset of the pandemic. And as you can see, there were a couple that were directionally correct, TD and Scotia. The rest were obviously not even directionally correct. And all of them were, many magnitudes of order off of reality. I think it's important to set the stage with the price growth that we've seen as a result of, COVID related monetary policy from February of 2020 to February of 2022. So you see a whole lot of green here. This is the average price change for detached homes in these different regions. You can see it ranges anywhere from plus 50 to plus 130% in a very short period of time, 2 years. So effectively, on record, the best performing bull run we have ever seen in the housing market. So it makes sense that when sentiment shifts, prices can come off pretty quickly. This is I've stolen a lot of tweets and charts here, but I've got it all sourced here. So this is from my friend Dan Foch. She's a great follow in the real estate analytics space. If we look at median home price now from February, so sort of the peak of our market, to June, you'll see that and this is for all property types, right? So condos, townhomes, detached, all rolled into one. Durham is suffering the most at negative 26%, Halton down 21%, Peel 20%, York region down 16%. Prices is essentially in free fall on a week over week basis, forget month over month. Toronto is flat at no 0% change. But what's interesting there is condos have been so far doing that heavy lifting. So when you isolate for freehold, you get a different picture. So this is all property types. You can see our peak here in February. You can see that some markets have fallen back to, if this current trend continues, we will see year over year prices in decline probably by the end of summer, if this trend continues. Currently, depending on the market, you're looking at sort of fall of last year pricing today. And so, January, February, at this point, January and February sales are bad data points. That's how far prices have regressed, how quickly they've regressed. Now, if you isolate for freehold, like I said, Toronto is down 15%. So what's interesting is condo prices are far stickier, which kind of makes sense because they were the least, that's the asset class that appreciated the least through COVID. And as a result, they're the least rate sensitive. Also, we've seen this before when you bite buying power, whether through stress tests or through an actual rate increase, price floor product tends to perform the best, and condos are that price floor product. Also important to remember, we saw urban exodus through COVID, right? People looking for more space in the suburbs, and we are now seeing a re-urbanization of demand. That's part of why rental rates are climbing so fast in the downtown core, looking at something like 20% up year over year. Rental market is absolutely on fire, pretty much regardless of where you are in the city right now. So this is sales price by location for freehold. You can see there that Toronto, I know the lines are hard to see. I apologize for that. This is from Habistat. If anybody wants to know, that these guys take all the TREB data and they scrape all the data and they put together really good charts. So I recommend going to check them out. You can see Toronto there at the purple line there, not seeing the same level of price regression, but in line with the trend. Now, if you isolate Toronto, the 416 by property type, the dark blue line here is condos. So this is the condo segment. You can see that prices have fallen maybe 5% since February at absolute most. You're not seeing failed closings. You're not seeing appraisals not come in, but the prices are down marginally. So condo prices are starting to finally roll over a little bit. Of course, they're not going to be entirely immune to rate hikes just because they didn't appreciate very much through COVID. You're still going to see some net effect there. Now, this here is one of my favorite charts. This is an interesting one. So this is the average selling price of a detached in Durham region versus a CO1, so the downtown district of Toronto, a condo. Blue line being obviously Durham detached. So what's really interesting is if you extend this chart back all the way to 2000, you'll find that within a 5 to 10% band of each other, a CO1 condo has always historically been than 5 or 10% of the price of a Durham detached. COVID changed everything. And you see that condo prices slide as you see the urban exodus, Durham detached absolutely run, and you see a gap widening that we've never before seen in history. It was easy to predict that at some point we were going to see some mean reversion in the market, and values always over a long enough period of time are priced relative to each other, right? And so this was entirely predictable, right? The idea that a Durham detached used to trade at about the same price as a Toronto condo and for a short period of time was roughly double the price was, of course, always going to correct. What most of us didn't accurately predict was how quickly prices would come off in Durham. So you can see here that the gap is rapidly shrinking, as it should. We probably won't go 100% mean reversion to where we've been in history, but certainly this is a trend that I expect to continue. What do we got here? One really interesting point to me is that we are still technically in a seller's market. This is the 416 months of inventory chart. Anything below 3 months of inventory is a seller's market. 3 to 5 months of inventory is a balanced market. 5+ months of inventory is a buyer's market. Generally, in balanced markets, you expect to see prices trade kind of sideways. In buyer's market, you tend to see some price regression. In seller's market, of course, you tend to see prices increase. Now, what's interesting is freehold prices in Toronto are down 15%. While we are still in a technical seller's market. That's incredibly interesting to me. That is one of the most interesting things I've seen about this market shift, is that while being in a technical seller's market, we are obviously, listing terminations is going to skew months of inventory. We're seeing more terminations than sales right now. And in terms of sales volume, we're at 20-year lows, right? So in June, the amount of transactions that happened literally haven't seen numbers that low since 2000. And obviously there are a lot of newly minted realtors thanks to COVID, a whole bunch of new folks in our space. And yeah, I mean, you know, there's not a lot of volume to go around. So this kind of brings the question, is there more price regression to be seen? Or, and I tend to go with the latter here, is Toronto, is the GTA a very forward-looking market? Meaning, is consumer sentiment very subject to change here very quickly? And I believe it is, because of the fact that prices are so high relative to incomes, and it's a highly levered market. So you start talking about rate hikes and sentiment can shift very quickly in a levered market like Toronto. So I tend to think that a lot of the rate hikes, you can see how quickly prices came off. A lot of the rate hikes were priced in. And on the note of rate hikes, the Fed is now, we're now seeing the market price in rate cuts in 2023 on the back of recession fears, right? So we are already starting to see the pivot. We're starting to see the headlines. We're starting to see the market and the bond yields move. We're starting to see indications that people don't expect rate hikes through 2023. And that makes sense. You know, you've got 2 quarters of consecutive GDP decline. It's starting to seem like we are in a recession. And as a result, you're going to see sentiment increase that rates are going to cut, right? Now, on the note of affordability, you guys all know this, but I think sometimes it's helpful to spell it out. This is a transaction that happened in Keswick. It sold in February for 1.24 million. Obviously, this person, well, not obviously, but more than likely that particular buyer failed to close. Appraisals didn't come in, so the seller had to resell for 9,655. So you're seeing a 24% price decrease on this particular sale in a number of months. When you take a look at what a 5-year fix would have been versus what a 5-year fix is now, affordability on this particular product hasn't actually improved. And that's something that's important to remember when you're guiding clients is, you know, with the exception being the down payment. And of course, this particular, I shouldn't have chosen this example because it now falls below the $1 million price mark. So of course you can go with lower than 20% down, but regardless, you get the idea here that affordability hasn't actually improved. And people forget that, you know, when rates go up and when rates going up is the catalyst that drives prices to the downside, your affordability doesn't actually improve. Now I'll take condos, like I said, 5 to 7% decrease on most, or at most rather, centrally located condos. The prices are very sticky. Quick update on the rental market. Never seen anything like it. You know, 20% year-over-year price growth in rental. Toronto condos, average rent up from $2,050 a month to almost $2,500 a month year over year. And if you look at the number of leases going for over asking, which is of course a phenomenon you only see in an absolutely insane rental market, you're peaking out right now at roughly this is the dotted line here. Almost 30% of leases are current in Toronto. Condo leases are going over asking. So rental prices are increasing, not unusual. And in a rising rate environment, you tend to see it, right? We're just seeing it to a very sharp degree right now. So, you know, condo rents in the core have more than recovered for their COVID decline. They've, you know, apples to apples comparison, they're up quite a bit from there. Now, I won't go through, if you want more of a detailed explanation on my supply demand thesis and new housing supply thesis, I'll point you to my YouTube because I just don't have the time here to go through it, because obviously I know we're going to want to take questions here. But I think that with all of that bad news I've just given out, it's important to remember why Toronto and why Canada as a whole has outperformed all of the other G7 countries over a number of years. This is a chart from Build GTA that shows the cost to build a 750 square foot condo in Toronto, excluding developer profit margin. So some of you may know that in order to build a condo building, you generally, in order to get your construction financing, need to pro forma at a 15 to 20% profit margin. Often the end profit margin is below that because of unexpected costs and delays. But what most developers will tell me, and I'm close with a lot of them, is they make the same amount of money selling at 15, or they make the same margin rather, selling at 1,500 a foot today as they did selling at 750 a foot back in the day. And that's worrisome for the new supply thesis, right? So here you have the cost to build it north of $1 million, and that's without developer profit margin, right? CMHC recently released a report that basically says we need to have 22 million housing units in Canada by 2030 in order to address supply. And at current building trends, we are only on target to have 19 million. So that's a 3 million unit shortfall. That is substantial. I have no faith in the government to be able to roll out policy changes in any way to make up that degree of housing shortfall. And even if they did, do we have the capacity to build that much in that short a period of time? And to be honest, I believe firmly that the answer is no. This is a chart of what we would have to deliver over the next decade in order to hit that target. As you can see, we seem to cap out somewhere between 50 and 70,000 housing completions per year. There is absolutely no way, snowball's chance in hell, that we hit that target. I used to explain the long-term housing market like this with, the supply factors and the demand factors, but honestly, it can be boiled down to simply this. Housing supply over people plus the dollars available to them, right? So demand can be measured in two ways: the amount of people who need housing and the amount of dollars available to those people. So if we start with just supply, like I said, cost to build is now over $1 million. You look at this, you say, well, which of this pie chart, I've added the developer profit margin. Which of this pie chart is the developer profit margin? Well, naturally, it is the smallest section of the pie chart. So here's your hard costs, soft costs, marketing cost, land cost. Here is your government related fees, including the new inclusionary zoning coming next year. And here's the developer profit margin. This is a big part of the reason why you see developers in uncertain economic conditions hold off from launching product. I've broken it down in this chart. Now this is a chart I made a little while ago. This number is much higher now, but you see the developer profit margin. The government on average takes over 20% of the price of a new condo. So the government walks away with more money on a new condo purchase than, of course, the developer does. Now, construction costs are up 30% for high rise since pre-COVID. That is obviously inflationary. And really, I mean, I sped by it, but the big takeaway here, if you take away anything, is the long-term thesis for this city is that replacement cost far exceeds the price of existing housing stock. That is bullish for the long-term outlook of the market. One of the other inflationary factors is, of course, we don't have a lot of building capacity, and that building capacity is shrinking because we are expecting to see 23% of the construction labor force retire in the next 5 years or so. And we're only going to see 6% come online. So another shortfall in building capacity. Developers are set to cancel 5,000 new units this year. It's going to be more, right? We've seen already more than 40 purpose-built rentals and new condo projects shelved in Canada in just the last few months. We're going to see cancellations of projects, right? So what I tell my clients is, if you bought something at pre-COVID, a pre-construction condo pre-COVID, and the developer hasn't broken ground yet, that project is likely in trouble, especially if it's not by a tier one developer. Less condos launched through COVID than what was projected. As a result, you're seeing new housing completions contract in the years following, as that product that would have otherwise made it to the market, the resale market, is not going to make it because it wasn't launched. It was postponed. We're seeing that already now, right? So a lot of developers who had launches slated for this spring and this summer have called me up and said they're going to push back. Some product that is launching is doing very well. Projects like Forma, right? The Gary site, luxury boutique, we're selling a lot of right now. What we aren't selling is commodity projects in the suburbs. So Mississauga, Vaughan, your 500 to 700K average condo on the pre-construction market is not doing so hot on new launch right now. And so a lot of developers are watching that and they're just saying, you know what, we won't launch. You can see the price per square foot of a new condo affected in real time by all these building issues. You can see that it's up about 20% versus a number of years ago. What's interesting is I forgot to include the other chart, but when you look at suburbs, so this is 416, but when you look at the suburbs, for example, the average launch price of a Brampton condo or an Oshawa condo, they're up almost 60% in the last 2 years. Inclusionary zoning essentially means developers will have to make 5 to 10% of their new condo projects affordable rental units. This will naturally decrease the amount of saleable units and the developers are not getting any breaks from the government. So the government's not saying, hey, we know you're providing the market with all this affordable housing. It's going to decrease your profit margin. In exchange, we're going to reduce your parkland levies, or in exchange, we're going to reduce your development charges. It's just an extra tax on top of housing. This cost study shows that a developer who could have launched at I believe the number was like $1,300 a foot would have to increase to $1,391 a foot in order to make up the difference with 10% affordable housing. So any projects zoned in the new year and going forward that have to include inclusionary zoning, you're seeing an immediate 5 to 10% bump on the per square foot, not including the cost to build going up, not including the 49% increase in development charges that Mark posted about, not including a lot of things, right? So the cost to bring new supply, if you look at a pre-construction price list and you look at an existing apples to apples, resale building, what you're seeing is a 20% spread, right, on average. But sometimes 30%, sometimes only 10%. It really depends on the project, but regardless, that spread is going to widen. Now, Portland also did inclusionary zoning, and they were one of the cities that rolled this out that did not give developers any sort of break in other fees in order to allow them to keep their revenue stable. As a result, you can see the new housing supply in Portland plummeted right after they implemented that, as developers realized it was no longer profitable. The market could not bear the prices they needed to charge in order to hit their profit targets, and they pivoted to other cities. This is a chart about unintended consequences. So everyone remembers the Fair Housing Plan under Kathleen Wynne. The headline items were first, the NRST, 15% non-resident speculation tax. And number two was basically a bunch of stuff for renters to make renting more affordable, namely the rental control. You can see here that it had an immediate effect on rental prices. We saw a massive increase in rental prices that broke the long-term trend of rental inflation. And so it's important to remember that a lot of the time, these government regulations are born out of good intent, but not thought through. It's very hard to address the housing supply crisis. And when you look at what the city is doing, the municipality is doing to developers, it almost feels sometimes like they absolutely do not want to address the problem. Scotiabank talked about the housing shortfall in a recent report. The big takeaways from this is we have the lowest.
Sorry, Jordan, you have to unmute yourself. That was my mistake. I apologize.
Okay.
I'm sorry.
I thought I was saying something illegal.
No. That was my mistake. I apologize.
Okay. So we have the lowest housing units per 1,000 population. So it's really not hard to point at housing appreciation in the G7 over the last decade and go, Canada's the highest. Well, here's your culprit, right? We are, out of 35 OECD countries, we are the 34th slowest at approving new housing, which is just an incredible stat. Just goes to show that our whole process here is broken and strangling supply. So like I said, the government says they want new housing supply, yet everything in the system makes it incredibly hard to bring new housing supply. We do things like we deem dilapidated old dry cleaning buildings on arterial roads as heritage buildings, and we don't develop them in order to preserve housing character. Now, obviously, this doesn't apply to every city in Ontario, but it's a pretty common thread. There's very few cities that buck this trend when it comes to strangling new housing supply and giving, not in my backyarders, most of the power. Obviously, zoning is a problem. You look at this map, you can see where all the density is. Blue is under construction, pink is planned or approved, and gray, or the white color, is existing buildings. And you can see here that, with the current zoning in Toronto, you can't tear down a single family and put up a fourplex, right? And so it's very hard to bring any of that missing middle, any mid-rise supply, and that is no small part of our problem here. On the people side of the demand equation, you can see here that we're actually slipping. So if you look at the number of housing units per 1,000 residents in 2016 versus 2020, you can see very clearly, right? We are not building enough to keep up with the immigration. If you zoom into the GTA, in 2019 and 2018 combined, we immigrated 252,000 people, or rather we saw a net population gain after looking at immigration of 252,800 people in that 2-year period. We built enough housing supply for 155,000 people based on the current per person multiple based on Census Canada. So how many people live in each type of dwelling? How many of those dwellings did we build? How much does that adequately house? And then you look at the deficit. We built 38,000 homes, too few in a 2-year period. Again, another staggering number. This was the Ontario population projection that was put out before the recent federal government's immigration targets had increased. You can see here that, if population growth is a concern, or rather the amount we're building for that population growth is a concern, well, that concern is going to get worse. And then on the dollar side of the equation, obviously we're seeing rate hikes. That is the primary reason why you're seeing prices fall. Now, I will say in the last 3 weeks, I've seen an uptick. Pre-Condo.ca is the 3rd largest pre-construction website in all of Canada. We have almost 100,000 unique visitors a month. And so we get to see traffic data very early. And in February, I started to see the amount of search volume drop pretty precipitously. So we're down about 20%. And that's unique data that allows us to kind of see where the market is going before it's actually felt in the market. In the last few weeks, things have been trending up, which is interesting to me. And a lot of my top producing resale friends will tell me the same thing, that showing activity has seen a minor uptick in the last 2 weeks. It's interesting to me because sentiment technically should not be improving. If all of this is rate hike driven, then we know that July, we're going to see a 50 or 75 point hike, most likely 75 points. And so sentiment should not be technically improving, but it seems to be. We're signing more units right now than we were a month ago. So that's kind of interesting to me. But what I really want to show you here is stress test 1.0, 2016, 2017. It did cool the market. We saw prices trade sideways for a little bit. The mechanism is different from rate hikes, right? Rate hikes actually increase your borrowing costs. Stress tests just increase your qualification criteria. And so either way, though, you're seeing a reduction in buying power. So mechanism different, but output the same, or rather effect is the same. You can see the stress test caused Toronto detached prices to kind of plateau for a while there. COVID, of course, saw them run again. And now rate hikes, you're seeing the prices come off again. Durham, same idea. Stress test takes effect, implements, prices trade sideways for quite a couple of years here. COVID, prices run, rate hikes, prices come off. Here's maybe the most interesting chart. Toronto condos, positively impacted by the stress test, caused them to run some of the best years in Toronto condo history. That just goes to show price floor product tends to perform the best in inflationary environments, in rate hike environments. You see COVID, obviously nobody wanted to be in the city. It was like, it's dead. It's beautiful for me, no traffic. And then rate hikes, right? So you're seeing prices cool a little bit on Toronto condos as well. I know we went through a lot of charts. I went through them very quickly because I wanted to get to the whole Q&A part, the back and forth. But I hope this sets the stage and helps a little bit look at the long-term thesis.
I hope you don't mind, Jordon. I'm going to take first question because I found that all very fascinating. And I'll tell you, there are questions. I think Ivar has written a question in the chat, which we'll get to right after mine, but I'm taking first question. It's often said that people buy a payment. They don't buy a house. Is there any data or is there any stats on what that payment actually is? That is to say, is there anything that basically has an average cost, or has anyone done an analysis of what the average cost is, where when costs start going above that, you can expect the market to fall? And similarly, if costs start going below that, monthly costs, that is, you can expect prices to rise. Is there such a data set that you're aware of? And is there any credence to actually investigating that?
Definitely credence to investigating. I haven't seen a study that draws that conclusions. I have seen some data on Twitter shared by Dan Foch and Alex Zealand that shows the cost of ownership of the median home through these rate hikes. And it's a pretty startling up and to the right kind of graph. And you're absolutely right. People in such a levered market, people do buy a payment more than they buy a home. And that's why you're seeing sentiment shift so quickly. Whereas in less levered markets like Saskatchewan, they're up month over month, right? Because far less leverage is employed in those lower priced markets, and so they're less sensitive to rate hikes.
Amazing. Okay, maybe we can get, I have other questions as well, but maybe we can get to Ivar's question, and then anyone who has questions, please write them in the chat and we'll get to them. So Ivar's first question is the increase in rental prices mainly because current renters aren't moving into purchase property?
That's certainly a part of it. But there's a lot of factors at play. Reurbanization is a big one, right? I have clients who own multiple pre-construction and resale condos with me, and a lot of them are being called back to the office. So it's more than one factor, but it's also, just generally rule of thumb, historically, when rates rise, so do rents.
All right. If anyone has a question, please unmute yourself and ask. I know it's a bit intimidating after you get data like that, because simple questions don't really do it justice, but please feel free, guys.
I don't have a question other than to say that was fantastic, Jordan. That's amazing data. This was really, really well presented. That's all.
I appreciate that.
So I have a question. I hope it's not too convoluted. Given some of the legal things that we're seeing happening with closings on freehold, things not, being appraised out, people asking for extension after extension, deals not closing, etc. In an environment like the one we're in now, and of course this is probably totally individual in terms of what people think about it, but is it make more sense to focus on condo product in an environment like this, or is that totally like a subjective decision?
Well, I think it's subjective. I think it ultimately has to do with what your client wants to do, right? Condos are definitely faring better. That doesn't mean they're immune to what's happening in the market. Me and Mark have frequently talked about what might be a systemic risk in the pre-construction market, where you have certain regions and certain projects where a high percentage of the people who purchased intend to actually assign those units at closing. And what's interesting to me about that is, when you're buying pre-construction at a 10 or 20% spread over the price of resale of existing housing stock, the question becomes, if the market trades sideways between now and closing, now obviously you have a buffer. The nice thing about new condo supply or buying pre-construction is you have a 4 to 6 year build cycle before that thing is actually taking occupancy. So the market can do a lot of heavy lifting for you. But if you are closing on a pre-construction, or your closing's coming up and it's worth the amount you paid or less, or maybe 10%, 5-10% more after fees and after taxes, you're actually negative equity on that property. And so there could be a cascade or waterfall where you see a ton of assignments flood the market, driving down the price, the assignment market. Now, I don't know how big of a risk this is, because I'll tell you, the vast majority of people coming to me to assign their condos today, they bought 5 years ago, and they're, even with what we're seeing today, they're up 100, 200, 250,000 on their condos. So that risk isn't playing out or anywhere close to that risk. But yeah, I mean, condos will probably outperform detached over the near term future. But at the end of the day, nobody really knows.
Thank you.
I just have a question on that same sort of discussion point. Jordan, if you had access right now and needed to deploy, let's say, $5 million of capital, would the purchase of new build condos be a significant part of that investment?
Probably the purchase of distressed assignment sellers condos would be a significant. That's where you're going to find a little bit of alpha there, because they're going to be selling below. There's a lot of them right now in the market, more than usual. So a lot of them are priced below resale comparable. So you're getting the newest building in a neighborhood at 5 or 10% less what a resale unit might sell for, and so that's probably what I would be looking for. The other thing is, a lot of the new launches in the 416 or the 905 even are 20% spread. So there's a lot of speculation built into that. And so, at the 45-year average of 6 to 7% appreciation a year, buying a new condo today, your negative equity on it for the first 3 years of completion, assuming the market goes up, to the typical degree. So I would be looking at that, but also developers who have lingering inventory that they held back at the time of launch. So instead of projects that are launched today, projects that launched 2-3 years ago, there are some of them out there that have really good deals.
If I may speak to that point as well, guys, I run a small to medium shop at the present time, but I obviously ran a large one for a long time, and I speak to people who run large shops. We are all being approached by people who are in distressed assignment positions coming up, and that is in excess of what we have experienced in the past. I don't want to make you think that it's replete, but there is quite a bit more, and so it would make sense to be focusing on those markets. Why don't we go through some of the questions, Jordan? I don't know if you're seeing them, but I'll read them. Do you know
Sure.
if the proposed recent 49% increase in development charges in the city of Toronto will affect current projects and developments, or does it only affect new projects? How do you think builders will respond to the increase? Let's start there.
I'm not sure. I don't think it has passed yet, but historically speaking, like I remember a project I sold in 2017 that I was very close to the developer because I did like 60, 70 units there. And I remember the developer calling me up and telling me, part way through construction, the city came back to the table and increased development charges by $11 million. So I don't think it's outside of their power to be able to do that, which of course creates an incredible amount of stress on the developer and on their margins. But I think this 49% increase would only apply at time of zoning.
And if I may, guys, because we have a bunch of realtors on this channel, there are any number of builders who are now, I'm sorry, this is a bit off track, but it is a legal channel, so you'll permit me. There are any number of builders who are now providing realtors with caps in quotation marks on their agreement. But what the agreement actually caps is the development fee that they are currently paying, meaning, which is something that was never really paid. Because usually what happens is the cap that is negotiated by the lawyer's office or at the sales office is usually on any increase in fees. A lot of people realizing that people aren't realizing this closely, and particularly in certain projects like Brightwater and others, what they're doing is they're providing a cap that seemingly looks like it's a cap, but it's a cap stating that we are allowing you to cap the fee that previously you paid nothing for. We will only charge you $15,000 of the existing development fee, and then the increases remain at your peril. And so you have to read these things very, very carefully and have people who know what they're doing. And if you are actually in the new construction space, please do make sure that you're paying attention to what the actual caps are that are being provided, because that will guard against the very question that was asked, which is, are these things going to be passed on to you? Well, they have a much higher likelihood of being passed on to you if fundamentally you don't get the appropriate cap. Jordan, maybe we can go on to other questions. Someone saying thoughts on, you did a good job when someone asks you about your interest rate prognosis, because no one knows, but it means that they think that you have some great insight. So thoughts on long-term interest rates, lock in or keep fixed or keep variable?
It's a gamble, but I think variable is the more likely gamble to pay off in your favor, given what the market is starting to price in. And I think when you really look at rate hikes and people say, hey, we need to get to 8-9% interest rate to tame inflation. I think if we get to 8-9% interest rates, you can find me under the gardener eating beans, because I think I think we're just too indebted as a country, well, not just consumers, but corporation debt and also government debt. I just don't think it's serviceable at those numbers. I don't think we see it.
Excellent. Anyone else want to jump in with a final set of questions? Please feel free to unmute yourself and ask away. Someone is asking what type of beans. So
I don't know, man. But you can come visit me and bring rice and we can share a meal.
All right, guys, last round. Anyone else for another question before we clap it? Okay, so Jordan, look, this was everything I was expecting. I've seen your previous sessions. Guys, I'm going to encourage you all to listen to Jordan. There are people out there who blab on and will give you their opinion, and they will sound really great when they do it, and they'll have all the conviction in the world, but it doesn't matter, because at the end of the day, an opinion is that. and it's different than facts. And facts are data driven. And that is why seeking out experts who actually analyze the data that's coming in and make predictive analysis on the basis of the data are really the best type of professionals, in my view, out there. Jordon is one of those. Jordon is probably the one I respect the most out there. I am incredibly grateful, Jordon, for you to coming by and speaking to our group about this. I'm going to encourage all of you to please follow him on his channel for obvious reasons. If you like this, you can see this almost every day. Follow him on Twitter. If any of you are wondering where I bought the hat, just DM me and I'll tell you.
Yeah, thanks for having me, man. This was a lot of fun.
Awesome. Guys, thank you. We appreciate everyone's time, and this will be posted shortly.